So hey, super excited to be joined here on a focus about crypto fiat. I'm happy to be joined here by Timo from Swarm Markets, Alex from Archax, and Rodney from GlobalBlock, looking at the ongoing questions on centralization versus decentralization, which has longer potential and more potential, and looking specifically at the ongoing debate between AML and KYC checks for safety and abiding with regulation versus innovation. And first question to throw at you all, there's an ongoing debate which I hear with pretty much every crypto and DeFi startup and company, looking at where to meet the right balance of AML and KYC and sort of wanting to stay on the right side of the law and being safe and being secure versus not hindering innovation and sort of not going against the ethos of decentralization. How does one meet that right balance between AML and KYC and not stifling innovation? Timo, I'm going to start with you there, because you've got a platform that's sort of notoriously or known for being almost the first one to be a decentralized platform looking at regulation. How have you gone about that, and where do you see the right balance is?
Well, I mean, I think basically it's a matter of making it as little intrusive as possible, right? So when it comes to AML and KYC, I mean, first of all, I think on the AML side, you would have to, the way we kind of approach it is that, we allow people to kind of engage with like smaller amounts of capital without like having too many questions asked about where the money comes from, et cetera, et cetera. But then once you reach certain limits, then, other processes kick in. And then, obviously, if there's some activities that we don't like, then, that kind of triggers further activity in the background. So I think there's like AML itself is kind of, you can kind of try to build that in a way that makes it like as little intrusive as possible. But in end of the day, there's like no compromising there, right? It is what it is. And you kind of have to do certain things around AML. And so there's no way about it, really. And for KYC, it's a little bit different, because the way we approached KYC is in some ways similar to what you would see on any kind of centralized exchange, in the sense that if you go through like the onboarding process of, let's say, FTX or some other exchange, you would have to, and you have the, let's say, intent to do like meaningful amounts of trading and deposits and withdrawal. Those processes are quite similar to what you see on Swarm Markets as well, but with the main difference that once you have onboarded on Swarm Markets, what happens from a technical standpoint is that we issue an NFT that gets transferred into the wallet that has been registered for that particular user, or multiple wallets if they choose to register multiple wallets. And it's only once they have that KYC approval in the form of an NFT in their wallet that they can actually do something on Swarm Markets. And so that basically is the way that we have approached it. And we think that, if you're serious about doing something on a trading venue, you are going to be willing to go through that process. We don't think that there's people that are serious about what they want to do from a trading point of view, just because you have KYC, because it's like, it's kind of, it is the benchmark that you are doing KYC. And I don't think many people are objecting much to do it as such. I think most people are quite used to it anyway.
Thank you. And Rodney, I remember being on a panel with you, it must have been 2017, possibly early 2018 at London and Partners, talking about the potential of decentralization, and if decentralized crypto companies really can go forward. I mean, this was a while ago, but what are you feeling about that now? And do you think that is possible for fully decentralized crypto companies to progress, or where do you see the balances being between meeting AML and KYC?
Well, I do, because again, as Timo said, it depends on the values that you're doing and whether they're serious. So if they're serious traders and it's actually a commercial enterprise, i.e. that's how they make a living out of it, or it's significant, then depending on which jurisdiction, they're going to have to worry about KYC ML, because you're going to assume at some stage they're probably going to want some fiat as well. So I think the critical thing is how easy can you make it and how seamless. So I like the way Timo's talking about the token. That makes sense. So you're not actually passing over the details, but you're passing over, you know, that's a valid person. It's like when you go to a bar, something, they don't need to know your home address or your bank account. All they need to know is you're over 18. That's all they need to know. So those sort of confirmations, I think, are the way it's going to go forward. Also, thinking a bit more globally, because I've just done a whole lot with Cardano, and we were talking about governance, and one of the really critical things is your digital identity. You should control it. You should be able to handle it. The question is who should be controlling it, and again, jurisdictions. But you could apply that to KYCML, so you can pass sufficient information. And in fact, if you look at some of the cryptographic primitives, like zero-knowledge proofs, you know that the thing is in a valid range, but you don't know all the specifics about the transaction, or you don't. So you could think applying some of those things. And if you talk to a lot of the regulators, I had a wee bit to do with the FCA, and I'm sure Alex can have a comment, they don't always say exactly how you are to do it. They are saying what information you should be aware of. And as Timo said, you know, I'm sure their system looks for patterns. So if someone's trading a large number of 50, 500 pounds quite regularly, you'd probably be going, hang on, every half hour there's 500 pounds going in or something. I mean, that's a really silly example, but you can start to see, even if it's below the normal KYC AML, or if it's, they can look for particular things. And I think it's going to be there. I think a lot of people get worried and say it's going to destroy innovation. It's not going to help decentralization or the KYC AML. And there is some truth to that, but a lot of it is because they don't want to deal with it, or it's been pushed by incumbents because they want to put a barrier to people to entry. I don't think you need to think about that it's there. It is there. I think the better thing to think about is how can you do it smarter, more efficiently, and what can you do to remove some of those barriers?
Yeah, no, thank you. And Alex, Rodney asked me to put the hardest question to you, so we'll do that by going to you, Fad. I mean, obviously you're coming from Archax, from a sort of one of the few regulated entities, and you've had your deal of dealing with regulators, presumably in sorting that. How have you found that balance to work for you guys over at Archax, or in general?
Yeah, I mean, I think it's really interesting listening to a lot of the comments, and like yourself, Erica, I've listened to a lot of the debate that kind of goes back and forward, and I think that we're at a very interesting kind of time in the kind of the interface between the regulator and innovation. I think when we talk about AML, KYC, and these requirements, a lot of the times I think it gets lost in the fact that these need to be an outcome focused process. It needs to, why do we do this? Well, we do AML, KYC because we don't want to create systems that can be used for illicit financing reasons. But a lot of the debate that we have at the moment comes around the encumbrance on users, and we need to take this kind of commercial view. And it gets very, very heavily lost in the the actual kind of process. And I think the regulators are starting to kind of apply a disproportionate amount or requirement on probably on the crypto side, because of they're getting incredibly heavily focused on the process and how we do things and why they need to be done without, as Timo, as we've said, without giving any kind of guidance as to what good looks like or how the industry should respond to that, and it's creating quite a kind of I don't want to use hostile, but it does seem a sort of a very kind of hostile environment where the regulators or certain regulatory bodies are now being accused of being anti-innovation in the way that they're applying some of these things, and I think a kind of a reframing of the debate and a good understanding by kind of everyone in the industry as to why AML and KYC checks exist, and actually the benefit that they provide, and the fact that we should broadly have a zero tolerance risk approach to financial crime in order to better promote the legitimacy of these new and novel asset classes is the net outcome everyone wants to get to. But and it's the approach that I think most people need to take, and in order to promote innovation as much as possible. I agree with Timo's point. I think everyone's used to going through AML, KYC. I don't think it's, it's new. I don't think it's an encumbrance for anyone coming to crypto. I don't really think anyone's really complaining about it too much, other than the firms that are trying to get regulators happy.
I'd just add an extra on there, Alex. I totally agree with you. But if you're dealing with emerging markets, not all of them have the identity that would normally meet an FCA regulatory KYC AML.
Exactly.
And having done a whole lot with Cardano and work with the guys out of Africa, it's an interesting challenge. So giving some identity is really important. And I think I like your comment. It's the outcomes you want and why you're doing it, not, we need 50 copies of this and it has to be this form of this passport. It can only be a G7-ish, all that. There's a whole lot of seemingly silly comments, but I totally agree with you. And I just wanted to add that because we're thinking, I certainly think a lot more globally. Obviously, with GlobalBlock, I'm more UK because that's where we operate. But I think you need to think about things globally, and it's worth taking into account why you're doing it rather than, well, we have to have this and have that.
Yeah, I think just to add that, because it's a really interesting point that you raise there, and that's the idea of the globalization, and with that, the concept of financial exclusion. And what we're seeing at the moment, there are a number of, we're at the cusp of potentially something that could truly revolutionize and, the financial industry and open up financing and, the financial markets to every single person on the face of the planet in a completely uniform way. And the way that AML and KYC systems are set up at the moment, particularly with people like FATF, etc. You have these cohorts of people who define what countries are on a blacklist or not on a blacklist, and who can and can't do things, and you effectively exclude vast numbers of people from being able to access these systems and really start to benefit in the way that the majority of the world. Afghanistan's a prime example now. Every single citizen of Afghanistan has basically been financially excluded. Even, Western Union won't even process it. And they are the people that require and need this more than anything else. So, to take it back to the beginning, and what Timo was talking about, we do need to deal with this in a productive and a proactive way, and we need to move away from probably the current norms of AML KYC and find innovative solutions, but that are as robust as possible in order to have a zero risk tolerance to financial crime.
And I mean, it's a super important point, because I mean, like all of you have said, it's one thing if you look at UK citizens, for example, where the majority of us have got ID and a digital identity and so forth. That's one thing. But if you look at sort of crypto going back, the vast number of users, and the largest users aren't in the UK or in America. It's Venezuela, it's Ukraine, it's places where for varying reasons, people don't have that trust in the government, the banking system, or they've got hyperinflation, or all aspects that are out of citizens' control for the most part, and have led huge numbers of population to crypto who need these solutions far more than arguably we do sitting here in London or wherever we all are. So it's a super valid point as to how that can be brought about on a worldwide basis.
I think when it comes to the jurisdictions, it's the way we approach it is basically being regulated in Germany with BaFin, where they basically classified all crypto basically, or the activity to trade crypto requires a license, right? Because crypto is a financial instrument in Germany, and so it means that we've basically implemented like a two-tiered model currently, where like if you're trading less than 5,000 euros, you only have to qualify with what we call tier 1, which is like a lighter approach to qualification from a KYC point of view. And it allows you to make those transactions up to 5,000 euros. But then beyond that, you have to go through and upgrade yourself, so to speak. And so we're using the analogy of a passport. So your passport is either tier 1 or tier 2. If it's tier 2, then you're in the next category, and then you can trade virtually unlimited amounts of capital. But then there are other AML checks in the background, kind of monitoring what's going on and whether it looks like legit activity or not. And then obviously there's source of funds checks and things like that for larger fiat deposits and such things. So I think it's possible to build like a tiered architecture by which you can actually accommodate, let's say, jurisdictions that get a lot of value out of just doing like sub 5,000 euro transactions on a DeFi platform. And they think that, it's actually a great thing to have access to that. but we're also able to at the same time accommodate for higher value kind of users that have, kind of a higher requirement as to how they would need to engage and participate in the activity. So I think you can build a technical solution for both, or like, let's say, for a broader category of users. And then, from a jurisdiction view, we're following basically the, obviously the OFAC recommendations for country participation and lists and blocking anything that's on such lists. And also at current, we're not allowing US users simply because we're not sure like how the SEC would view a decentralized licensed trading venue in Europe. There's no precedence for how they would view such an activity. So we're staying out of that for now.
No, thank you. And moving on to the trading side of things, I mean, Timo, we've already spoken previously about sort of seeing the decentralized approach as potentially preferable even for gaining investment. But where do you see as sort of the advantages or disadvantages of going for a decentralized model over a centralized market structure, looking at lending and trading between equities and other securities?
Well, so, I mean, on the positive side, I mean, the way we look at it is that there's a certain amount of like, the self-custody aspect of a DeFi solution for advanced users is a plus, right? So it's something that people appreciate if they're used to dealing with DeFi platforms, to have control of your own funds. And in the case of, let's say, institutional engagement, you have the control of using whichever custodian that you see fit, and that has actually passed through your compliance as an institutional kind of trader or investor. So we think that self-custody is important. And then we also think that the composability that comes with decentralized architecture is super exciting, because then you can always all of a sudden start using your your assets as collateral across various platforms, not only on the venue that we're providing, but also, connecting that to other partners that we have in our ecosystem. So we think that architecture is, has a lot of benefits simply because of that. And like one tangible example is like, if you have, let's say, if you're trading tokenized stock on, let's say, something like an FTX, it's that stock is stuck on that venue. Whereas, if you use like a tokenized version that sits with a custodian, but that's basically where the token that represents the asset is available on a DeFi platform that can be used as collateral for, basically on lending platforms and other use cases, or for stablecoin issuance, for example. So there's a number of things that you can do on a decentralized architecture that are, not possible or much more difficult to do in a centralized venue. And then there's also on the other side of, DeFi, it is more complicated to operate those platforms. I mean, you kind of have to know what you're doing when it comes to wallets and things like that. And so over time, our objective is to build away those complexities, but, give the option to those who are advanced users to want to actually access DeFi using their kind of self-custody infrastructure to be able to do that. But then also for other users, we actually want to hide all of that complexity so that they don't really know like what's going on, and they don't necessarily care, because they're there to, for a certain kind of investment purpose, or to do a trade, or to use some asset as collateral. And they don't really care if it's DeFi or CeFi or how it's done. They just want to get their thing done, right? They use their...
Yeah, no, thank you. And Alex, I mean, what are your viewpoints on that, on the centralized versus decentralized for trading? Obviously, Archax have gone down a different model.
Yeah, I think it's interesting. Timo's last point as well is, again, listening to a lot of this stuff, a lot of people just want the experience, or they just look at the outcome. And I think that, if you had an equivalent outcome for a user, and one of them was in a decentralized expression and one of them was in a centralized expression, but the outcome was the same, I think users would generally be pretty agnostic in terms of the way they do it. So I see it as less as is one better than the other. I think maybe one of them is more forward-looking and likely to be able to iterate and be more innovative, and that's probably on the decentralized side of things. But when we're talking about regulated securities, regulated trading, and we're wanting to start engaging with institutions, and effectively we're trying to increase the efficiency and move the needle on the incumbent financial services market, I think it's going to be very difficult to really express that to the same extent and volumes that you see it today in something that is decentralized, not because there's something preventing it, other than you would need to take the regulator and all global regulators on a journey with you and get them all to the same point at exactly the same time. And I think that would, that's really what's going to be the struggle here in the DeFi, in a decentralized kind of world. Whereas, it's a lot easier to speak to a regulator if they already understand the underlying governance structure and corporate structure of the firms that they're trying to regulate. And I think, that's kind of why I actually, think we're probably more likely to see quicker regulated innovation within the centralized side, just because the regulators already get 50% of the story. Sorry.
Yeah, no, and certainly when speaking to users, they want to know about security and custody.
Exactly.
And it more depends on the platform and what they're doing custody wise, as far as I can see, rather than if it's centralized or decentralized for the actual user experience in some cases. Rodney, what are your last views on that?
Timo and Alex made some really, really good points. And I think the key point is the users don't really care. If they are a regulated or a public company, then they probably do, because the auditors are going to care, or their listing requirements have certain controls. So you need to think about some of those challenges. But the other thing I think about when I look at DeFi and CeFi is liquidity in range, because you could assume some of the big institutions, some of the bigger players, if you're looking at the traditional finance system getting in there's some huge volumes going through some of those platforms, and they want to be able to do the same sort of thing using digital assets, not necessarily one for one. But so in that case, you're going to need to look at, well, who's going to provide the liquidity? What is my security? What is my custody? Not just, I used to work with Credo, so I know Credo's just set up working with enterprise MetaMask. So there are ways coming to do custody, on DeFi. But I still go back to, as Alex said, if I'm a regulated entity or a public company, I'm also dealing with regulator, they're going to be a lot more comfortable with something they can see as a structure they understand. Interestingly enough, some of the DeFi companies that I've seen the US regulators going after, they go after the developer or somebody that's actually registered a company to try sell something. So the platform itself might be decentralized, but they'll look for the person or persons that have actually been running it. So it's a really grey area. Timo's, they've got a regulated platform. So effectively, that still could possibly work for a regulated or a company that would look for CeFi, because the German regulators know them, they're accepted, so they've got a point of effectively, not necessarily want to litigate, but they've got that security there. I think those things are going to be really important. And to me, one of the things I'd always look at is, what's the liquidity? What are my outcomes I'm going to drive? And DeFi might be an appropriate platform, or CeFi.
Yeah, it's an interesting point, Rodney, that just quickly to do that, as of someone who used to work sort of on the regulator side, one of the first questions that they will come up with is, if we need to take a regulatory action, where do we point the email at? Where do we point the letter at? Where do we, where's the door that we go kick down at 5 a.m. in order to get, that? And when the answer to that is ethereal, they're immediately incredibly nervous. So genuine DeFi, kind of smart contract controlled ways of doing anything is I think from a regulatory point, it's going to require a paradigm shift in the way regulators conceive compliance and regulation before that can really kind of kick off. And I think we'll end up seeing a lot of kind of hybrids. Hybrid kind of structures, before we slowly get there. And hopefully that won't encumber innovation too much.
Well, I'm part-time at CMS, the law firm, and have sat in some very interesting conversations about what happens in a DAO. Who do they go after? How can that be? So, even in the most decentralized platforms, there's still the exact same questions on from a legal regulatory point of view, the same who is ultimately liable, what will happen.
was going to say, I've just spent a bit of time at the University of Wyoming, and they helped craft the DAO legislation. So I've actually talked to some of the people up there for some stuff I was doing. And what's really interesting is they do have a DAO, but guess what? There's still a named party behind it.
Yeah.
No, they haven't changed that. So it's not much different for a company.
But I think it's, it has to be hybrid models. If you talk about like licensed activities such as custody services and trading services, it's like, because otherwise you end up in this kind of pancake bunny scenario where there's like nobody to go after. You don't know who's operating the platform, and like nobody is serious is going to put like, institutional capital on a platform like that. So they can't, right? And we're seeing that even with like well-respected platforms such as Aave, they can't onboard institutional capital because they can't basically identify the counterparties that's doing the peer-to-peer lending on their platform. So therefore they've formed this thing called Aave Arc, because everybody has to be identified as counterparties, and then you can all of a sudden bring in institutional capital. So that's where where the world is right now. I think it'll take a very long time before DeFi gets to a point where it gets like generally kind of embedded into legislation with regulators. But you actually have to do these hybrid solutions, such as the one that we've done, which is based on a, fully decentralized infrastructure, in this case, Ethereum, and then also we're doing Polygon. But I mean, at the same time, we have these centralized functions which are related to our licensing structure and the things that are, let's say, requirements in order to operate under that license, which are obviously reporting and onboarding and KYC and AML checks, and all the other requirements that are associated with custodial services and trading services. So how are you going to do that? Like, even with a DAO, you could argue that you can kind of vote for, the designation of those roles, but they would still have to be distinctly identified individuals or organizations that fulfill those roles. Otherwise, the whole thing falls apart, right? So it comes to counterparty, identification and certainty. That's the whole basis of which trust is built once you get to the regulated level. Now, you can build like trust on something like Ethereum once you understand how that operates. But that's not the same kind of trust that you're looking for when you're operating like under regulatory licensing. So it's just two different things and two different trust structures.
Guys, it's an ongoing debate, but thank you all so very much for your time and points of view on this, conscious of times. But thank you so much, Rodney, Timo, and Alex, for joining us, and hopefully we'll have more of these debates in person in the not too far future.
Awesome.
Pleasure.
Thank you very much.
Thank you very much.
Thanks, guys.
Thank you.
Cheers.
Thank you.